All right, Monday afternoon on Fox 9 all day, and of course, Money Talks on this Monday afternoon. Money Mondays? I don't know if that's the term for it here, but always a good time to talk money on a Monday, and for that we always bring in Jason Brown, market insider, for some perspective on a couple of big topics. Good afternoon. Thanks for being here.
Rob, good to see you. And I like Money Mondays. It has a good ring to it.
Money Monday. Yeah, it sounds like a song. It probably is a song somewhere. The one topic that came up here that we're going to start with was President Trump floating this idea of 50-year mortgages. And he had a picture, an image of himself with 50-year mortgage, and it was it FDR with 30-year mortgage? And because that was seen as a big change when the 30-year mortgage was introduced to help people afford homes. I mean, that was a major change. President Trump, seeing the idea of a 50-year mortgage, could do the same thing, make home ownership more affordable. But even the Treasury Department, among others, kind of pushed back, saying, yeah, that was, something being floated, but there are some downsides. What's your take here?
Yeah, so I think when you think about the landscape big picture, having more options is never necessarily a bad idea because you don't have to use it. So the 50-year would be there should it get approved if you need it, but you can always opt for a 30-year mortgage. I think the other thing that consumers need to think about is you can opt for a 50-year mortgage, assuming it gets approved, but you could still pay down the mortgage loan as if it was a 30-year mortgage. So it's really about being financially astute and knowing, why would you take a 50-year mortgage? Maybe you want to lock in the lower payments, even though you're going to pay more money to treat it as a 30-year mortgage and pay it off the same time as a 30 and avoid the interest rates, which brings you to some of the questions that you might want to ask, which is, what is the interest rate? Because I'd be surprised if it's the same as a 30-year mortgage. So you may actually be paying a little bit higher of an interest rate. So you got to ask yourself, is that worth it? And I think as a country, we have to ask ourselves, what is this really saying about home affordability? The fact that we need to float a potentially 50-year mortgage rate. If you look at a mortgage rate right now, if you pay it over 30 years, you end up paying double for the house. Yeah. So you start to look at paying it over 50 years, you're paying a lot of interest, and some experts are saying it's the new form of renting because basically you're not building any equity into the house for a long time.
That's a good point there, is that, you look at home ownership, even with a 30-year mortgage, is that is how you build equity. That is how you maybe build some generational wealth. And if you knock it down to 50 years, how much equity are you building? I mean, it's going to take a while to build equity that you're getting any value back out of that, right?
Yeah, it's going to take a long time to build any equity because you're going to be paying off that interest in the beginning. Now, not to be all doom and gloom about it, if you look at the other side, let's just say you're trying to get into your first home because home prices keep rising and you don't even expect to stay there for more than 2, 3, 4 years. You just want that price to increase, and then you move out and then you build a little bit of equity that way, and maybe you're able to put more down on a home and then roll into a 30-year mortgage. So it kind of goes back to what I first said. It's nice to have options. I think it just becomes scary when the only option for someone to get into a new house, because interest rates and the cost of living is so high, their only option is a 50-year mortgage. Then that starts to spell trouble for the economy and for younger people building generational wealth. But if it's just an additional tool, it's not that bad, actually.
Yeah, I guess you're right. If you use the tool correctly. Yeah,
you got it. It's almost like a credit card. It doesn't matter what the interest rate is, you can swipe it, but as long as you pay it off at the end of the month, you're building points, stuff like that, no problem. When you start to say the only way I can afford to pay my bills and buy groceries is by going into debt every month, then that becomes a problem. And that's what I see with this. It's a tool, but if that's the only way that most people can afford a new home, then we're kind of, headed down a troublesome path with cost and inflation is what that's really telling me.
And we should be clear, this is a proposal that the president floated out there. It's not actually an option and may not be.
Absolutely. Like I said, if it gets passed, then we'll have to look at it. Is it a tool, or is this the new normal, the only way that people can afford a house?
All right, 401k contribution limits were raised by roughly about $1,000 or so last week. Partially, this is sort of an inflationary measure, right? I mean, but what does this mean? I know I read that the average, it's only 14% or so of contributors are doing the maximum already. Maybe I don't know. What can you tell me about what effect this actually has?
Yeah, so when you think about 401k, like you said, only a certain amount of, there's two percentages I think that's important to pay attention to. And one, I didn't research this one beforehand, but I should have, because it would have been interesting to have a factual number. I wonder how many people are even actually contributing to their 401k, let alone maxing it out, right? So if 14% are maxing it out, how many are actually even contributing to a 401k? And so raising the contribution limits, it's only going to impact, let's say it is 14% that's maxing out. That's assuming those 14% even want to contribute an extra $1,000. So it's, again, on the good news side, it's nice to have the option to put away another $1,000. You get that tax benefit from it. And then I ran the math. I said, if you put an extra $1,000 away into a retirement account over 30 years, that can grow to an extra $67,000. So that's a nice chunk of money to have over 30 years just by adding an extra $1,000 to it. But I think the real discussion is, how do we get people to contribute to their 401k accounts, whether they're maxing it out or not? Because we are the generation that's coming up that there is no more golden parachute from a company that's going to give you retirement. You are now responsible for your own, for putting money away. And I think the government had said that most people are not putting enough money away. And so as people either A, aren't putting money away, or B, earning more in their later years, they're starting to put more away then. They also increased the max contribution for people over, I believe it was age 55. They upped that limit as well, because they're saying, hey, it can help with catch-up contribution. So it's a great discussion. I think it needs to be focused around, how do we get young people to start funding it earlier now, because they're going to need it later.
What is your advice on 401k? I mean, I've heard a lot of people say you should max it out because the benefit you get is so great. I mean, what do you tell people about how much to contribute?
So I think maxing it out, you have to look at the pros and cons of maxing it out. So let me give you an example. When I was back in the corporate world and I was working, my company only matched, I believe it was up to $3,000. So if I put in $3,000, they put in $3,000. So basically the total was $6,000. In my opinion, I could have maxed it out, I believe, let's say 8,000 or 10,000 or something like that. The question I had to ask myself is, why would I put in more than the contribution limit that they match? Because I would rather take that extra money and either go into the stock market, create a Roth IRA or a self-directed IRA where I can get some additional tax benefits in the Roth where it grows tax-free, or could I put it in the stock market where I have a little bit more freedom of the stocks or the investments that I pick outside of, at that time it was Fidelity, outside of what they offered me? Could I go into the open marketplace, pick some different stocks and get a better return on it? So I think you have to think about all of those options before you just say, should I max it out or should I not? Now, if you don't believe you can get a better return outside of the strict offerings that they have, it may be best just to max out that 401k and take advantage of any employer match.
Well, certainly look at what your employee or employer match is and contribute.
Absolutely.
That. I mean, you get every cent of that you can. Max that match.
That's like free money.
Yeah,
that's 100% return right there.
Yeah, you can't get better than that. And what's your slogan about a profit is?
You never go broke taking a profit.
Yeah, I love that.
You'll never go broke taking your employer match either. Probably.
No, you won't. Let's talk about how the stock market is doing. I know late last week, maybe Thursday or so, it was right after the government shutdown ended, but stocks stumbled, and part of this has to do with a lack of government data that investors use. The information coming from the government that kind of informs the future of certain commodities, et cetera. I mean, what do you see happening on Wall Street?
Yeah, so there's a couple things. Obviously, the government shutdown itself was not good for the market. You have a lot of government employees that have gone over a month without their paycheck, and you're going into the holiday season. So you're seeing the market pull back because the market's saying, are people going to be shopping? Are they confident about spending money, buying cars, buying gifts? So we might have a weak retail holiday season, which is going to translate into weaker earnings. So that played into the stock market selling off. I think the second thing that played into the stock market selling off was you really had the Mag 7 stocks holding up the market. For those who don't know what that is, that's the Apple, Tesla, Amazon, Google, Nvidia. Those stocks were holding up the market pretty much a good portion of this year. And as tech started to roll over, people started to take profits in the Facebooks, Apple, Meta, all those big stocks. You saw the market start to pull back. Now, when you look at the long-term trend, the market has pulled back. When I say the market, the S&P 500, the Dow Jones Industrial Average, the NASDAQ Composite, which is the three big ones that we look at, they've all pulled back to their 50-day moving average, which means the sum total of the people who bought, sold, are at about the same price over the last 50 days. That is a normal place where the market bounces, where all three of these indices bounces. So it doesn't spell trouble yet. The uptrend is still intact, and as we know, the market just doesn't go up every day. So I think sometimes when we get those pullbacks, we get a little bit nervous. But right now, we're still looking healthy.
All right.
Guys, I have a quick question here.
Oh,
Sorry,
Amber's got a question.
You can't see me, voice of God back here. But Chris, can we pop up the stock market look right now? Jason, can you just explain to me what exactly, what's happening today that is causing this?
Yeah, so I always say trying to figure out day by day and moment by moment why the market is down is hard to do, because any news, investors don't just make a decision day by day. You got people taking profit. The market was up in the morning and now it's starting to pull back. It's just the normal ebb and flow of the stock market. And it's not down so significantly that you're like, whoa, like the Dow's down 500 points, but it's not down like 1,000 in one day as if some news hit the headlines. And then I don't know if you can pull up a longer term chart, but as I look at my screen right here, if you go back just to November 7th, which was 10 days ago, we pulled back to the 50-day moving average. If you go back to October 13, we pulled back to the 50-day moving average. So we are right back where the market has bounced at least 2 times in the last 60 days. So to me, it's just a normal reaction to the market, the normal ebb and flow, I should say, of the market.
Yeah, sometimes when you see those, those charts, when you're looking at a short time span, it looks like you've fallen off a cliff, and then you expand it out and you see that, oh, that is kind of happened multiple times here. But I mean, you would, I don't know, hard to know. I mean, but you're the guy that's done well with the markets. You would expect that to start coming back up?
Yeah, so we call this an inflection point as it's pulled back to the 50-day moving average. We say, hey, it has bounced, or people started to come in and buy here. We're back at an inflection point. So if it breaks the 50-day moving average, then we have to start saying, why is this time different? Why are people not ready to come back in and buy assets at this price point? But so far, we've just pulled back to it. We haven't broken it, so I don't think it's cause for concern just yet.
That's always good to hear from a money guy. don't panic. Just
and then I'll say this as well. You also have to think, when the market pulls back, it has always been an opportunity. When I say always, long term, the market goes higher. The Dow Jones, the NASDAQ, the S&P 500. So sometimes psychologically, we think that the market's selling off. What's wrong with it? But those of us who are in the market says the market is selling off. Yeah. Get ready. It might be time to put some money to work and get some assets at a discounted price. Yep. So viewers might want to change their mindset and look at the sell-off as a good thing. It gives you an opportunity to jump in if you've missed a big run-up.
Opportunities. All right. Thanks so much for your time here on this Monday afternoon. Appreciate it. Always sound interesting advice from you and insight. Thank you.
Thanks for having me on.
All right, there you go. About 1:45 here on this all-day Monday. We have another interesting interview coming up here, and that's about expanding accessibility in parks, specifically one of the biggest parks in the metro, Lebanon Hills, in a really interesting all-terrain way to help people get around. Amber, I believe we're going to take a break here before we get to that interview, so we'll be right back after a couple of minutes with Very, very cool option, and it's free at Lebanon Hills Regional Park. We'll be right back. Fox 9 all day.